coming to equity funds, and these are like, if you look at the AMFI data, okay, it will tell us that it's a big portion of our overall investments goes into equity funds. Of course, predominantly the AUM of the industry, that is asset under management, is driven by liquid and non-equity investments. But equity investments, if you look at that share of equity funds within the overall asset under management is increasing. So when you look at equity funds, so they are predominantly investments which follow the market capitalization process, or which considers market capitalization to decide on the equity investments. And what is market capitalization in a very simple language? Market capitalization is basically a number of shares which are outstanding into the price of today's share, which defines. Okay. Higher the market capitalization, the more stronger the company is supposed to be. It is supposed to be believed that it is much more stronger. But there are a lot many catches behind the price also, right? So like classic example, like Yes Bank was, a large cap at one point of time. It was a index stock. But then, okay, there are a lot many other criteria which come in, right? The kind of company, how the company is managed, how things are looked upon when it comes to the shareholders' interest, and a lot many other things. So if you see how the market capitalization within India is defined, okay, so large caps are the top 100 companies. That makes a pool of 100 companies. So when you say when you plan to invest in large cap, in a way you are going to invest into top 100 companies in India. When you say mid cap are the next 150 company. So 101 se leke 250 is what mid cap companies are all about. That makes the pool to around 250. And then there are remaining are small caps, where the count is almost close to around 1,700. That makes the overall companies which are listed in India are around 5,000. Now, these are big companies, steady companies, where ideally one should look at investing into. These are upcoming companies at their nascent stage, looking forward towards growth. And then you have small cap companies which are just started, or okay, a lot of companies who have reached to a stage and then you'd like to grow more aggressively. Let's take one step further. So one is on market capitalization, how big or small the company is. That's how one can decide on what kind of equity funds you would like to invest into. And that is on the, if you look at how the market capitalization ke hisab se, how these indexes have done. So there are many people who say that I am more comfortable with a mid cap or a small cap. The point is that if you keep it for a longer period of time, you see that most of them were very close. So 100 rupees invested in a Sensex right now in May 2011 would have been somewhere around 300. 100 rupees invested in a mid cap, which is a blue line, is somewhere around 350 rupees. And 100 rupees invested in a small cap is closer to around 300, where very close to where the large cap or Sensex is. So you see that most of them are around each other, but at the same time, if you see the volatility, the red line, because they are, the bottom 4,700 companies, the volatility is high. The green one, which is the Sensex, which are well-established company, the volatility is much lesser compared to the blue one and the red one. So keep in mind that whenever you look at constructing your portfolio, the ideal way to create is, of course, we are going to discuss it further, but ideal way to create is have a major chunk of your portfolio in large cap, and then probably, if in case on the basis of your risk appetite, you add an element of mid cap and small cap. Because if you see the over a period of time, okay, and whenever there are crises, now this period is your when COVID happened. Just see the fall and till what extent it can fall, right? So small caps actually started falling long back. Mid caps, of course, were going along with the big companies, but the fall was equal along with the big companies. But if you see where mid caps were at one point of time and where it reached, okay. So basically the point is that depending on the market conditions, okay, these companies will behave in different manner. But this graph also tells us one thing, that if in case you're looking for at least some peace of mind at the time of equity investment, it is always better to have a reasonable allocation in large caps. So that is on capitalization. Now let's look into the sectors, because that's another thing which builds up over the period of time within the equity funds. What sector the money is invested into. So typically the investments will happen across all these sectors. Just to give you some sense of how many sectors are there and how many companies are there within these sectors. It also tells about the opportunity of investments that are available in equities as well. Of course, the filtering is also on the basis of how good the company is and what are the prospects of that sector, particular sector is all about. But the pool is big, and the pool is scattered across different sectors as well. It also talks about the opportunity as we discussed. So when you look at equity funds right now, they're basically into two parts: diversified and thematic. That's where predominantly investors like to invest. You have a large cap, say like a value. So this is large cap fund where the investments will be only in big companies, as we discussed earlier. Okay. Large and mid cap will have a mix of your top 100 and the remaining and the next 150. So around 250 is where the companies, which is a pool of mid cap. Flexi cap will have a mix of your large cap, mid cap, and some allocation in small caps. Multi cap is the category where by default the investments will be around 50% maximum can be in large cap and 25% in mid cap and 25% in small cap, mandatory. Then we have value style of investing, okay, which is another category where usually the funds will look at companies at a fair valuation or at a cheaper valuation. And then you have mid cap and small cap, where the investments will go in companies which are at that nascent stage of around, and what we said is around 150 companies, and then the small companies. If you look, we have highlighted few things here. So if in case you want to take limited risk, then these set of companies are much better for, these set of funds are good for you. A bit more of risk will get added if in case you get into mid and small caps. Then comes the thematic funds. Like a lot of people have shown their interest in investing into banking funds. Okay. At the same time, they may also like to invest into infrastructure fund or a pharma fund. Now, keep in mind that when you invest into banking fund or pharma fund or technology fund, you are only investing in one particular sector. So you're taking more risk. These funds have all the options to invest across all these sectors. So the risk is going to get divided. Of course, the return potential would also vary here because you are betting on one sector, and if that sector tends to do well over a period of time or during a short term, your returns will look more attractive because you're taken more risk of being into just one sector. So it is very, high risk is what we are saying, focused on a particular sector or theme. That's why we have marked it in red. And there's another segment of funds which are coming up in India right now. That's international funds, which allows you to invest into international stock markets or companies listed outside India. So where we suggest to have a very limited allocation to begin with. We will discuss about the allocation in subsequent slides. So of course, these are the commonly, I think we did touch base on this, commonly invested equity funds, and we did talk about where these investments are going. And so most of the time we have seen investors preferring these funds. Of course, there are some investors who would like to take exposure towards your sectoral funds as well. So how to select the right fund is a is a very important question. So according to us, your investment in equity should be based on your goal. So you should only invest into equity funds if in case you want to invest for more than 5 years. or if in case you want that money after 5 years or so. Do not invest into equities if in case you are looking for that money in 1 year or 2 years. It may give you returns. Of course, we saw that 1 year graph where it was going up and down, okay, and a lot of volatility will be there. But there are also chances of you making negative returns. So do not park anything. Let's say, for example, you want money in 1 year or 2 years. You are better off investing into non-equity funds rather than equity funds. Then the second thought that should be there in your mind when you're selecting the right equity fund for yourself is at what stage of investment we are. So what we put forward is, if in case you're a beginner, you should look at large cap and index funds to begin with. It's much more stable investment because the investments are only happening in your top 100 or top. If in case you go in index fund, then it's just happening into top 50 or top 30 companies in India. Where in index funds, the investment, they will follow completely the in Nifty or Sensex companies in the same weightage. More safer, more stable. As you progress, as you gain some more experience in mutual funds, then you can look at investing into the other categories that we talked about, large and mid cap, flexi cap. You can add those, except small cap and sectoral, because the risk element continues to be high in these kind of funds. And at one stage, when you are at the advanced stage of your investments, you can look at adding small allocation into mid and small cap as well. But still, in our view, you should avoid sectoral funds. Now, typically what we say is, if in case your 80 to 90% of your portfolio should be your core and remaining 10% can be your some surplus that you have that you can use to do experiments in your overall portfolio. That's where you use sectoral. But if in case your overall finance do not permit you to take that call of that surplus, then you better avoid small caps and sectoral funds at the initial stage. Your risk appetite should also help you to decide the right fund for you. So I and my friend could be having the same risk appetite, okay, but at the same time, I am more long-term in nature, he is more short-term in nature. Then the funds that we are going to invest into will also differ. Where the fund is investing, the portfolio details, the holdings, which companies does it invest into. So we also saw there are more than 5,000 companies which are listed in India right now. So which companies the fund is investing into? What kind of market capitalization split the fund has? So I want to be more in large cap, but if in case I go and invest into a multi-cap fund where only 50% of the money will be invested into large cap and the rest will be into mid and small cap where the risk is high, then there is a problem. So look at the market capitalization breakup. Sectoral breakup, we saw there are so many sectors and the opportunities to invest into sectors and industry in India. So look at those sectors information, which one you are comfortable with, and then you invest. So look at the portfolio details. And of course, in the end, look at the performance also. But while looking at performance, look at the long-term performance, do not look at the short-term performance. Like 1 year we saw how it can be. Okay. More steady is 5 years to 10 years, and that will give you a much more better picture about which fund will work for you and which fund is right for you. So how do we construct an ideal equity portfolio? So there are close to around 350 equity funds right now. All you need is around 6 to 10 funds. So to construct an ideal portfolio, and this is predominantly for investors who are expecting around somewhere around 11 to 13-14% from their equity portfolio over a longer period of time, and who have moderate risk profile. If in case you would like to construct your portfolio, then maybe you have one index fund in your portfolio, maybe around 1 to 2 large cap funds, then around 2 to 3, ideally 2 large and mid cap fund, and around 2 flexi cap fund, and then add, if in case your time horizon is, let's say, around 10 years or 12 years or maybe around 15 years more, okay, then you add an element of a mid cap fund. Otherwise, you are fine without this mid-cap fund also, because some allocation of your large and mid-cap and flexi-cap fund will also go in a mid-cap companies. Okay, and some allocation will also go in small-cap companies through these funds. Okay. So what happens is when you construct a portfolio, because we have seen portfolios where, equity portfolios where overall holdings have been around 15 funds and 20 funds and 25 funds. You don't need to hold those many funds in your portfolio. I think 6 to 10 funds are good enough, and the right spread of funds will help you so that you do not. There's no massive overlap into the overall portfolio of the fund, because a lot of times we have seen that most of these companies are most of the companies are common, which will be by nature it will be common, but at the same time you have to look into that what percentage of your overall portfolio there is an overlap. A portfolio overlap of around 30, 40, 50%, 60% is also fine. But most of the time what we have seen is there's a massive portfolio overlap of around 70 to 80%, okay, where you end up losing out on the opportunity of diversification. But that's another thing that one has to look into when you look at the equity funds. But what happens with these funds, it gives you an opportunity to invest into the bigger companies, the growing companies, at the same time some opportunity to invest into companies which are at the very initial stage. That helps you to give some element of energy in your overall return prospect. So I think there was a lot of deliberation, and we did look into how much long-term investing should be and how long we should hold it. One element is, and this data is from Amphi, just to tell you, it says that 46, almost, let's say that it's 44%. So 44% of industry equity assets stay invested for more than 2 years. If I have to read it the other way, it tells me that 56% goes out within 2 years. Now that's a very scary number. That's a very scary number. So I would suggest that whenever you invest into equities, have the right. So if in case you have selected the right fund, it is better to hold it for a longer period of time, because if in case we go back and we see the kind of returns that investments have been able to generate, it's easily between around 11 to 12 right now, considering the current market conditions, okay, which is still better than any other asset class in India. Because there could be debates where we can say that real estate is another asset class which would have given that kind of return, but it's very subjective. It's very subjective. It depends on the location. It also depends on the how the real estate market within that particular community or area has done. Okay. So it's very subjective. Plus, it has an issue with liquidity. So when you look at real estate, okay, there are potential, but it's in pockets. When you look at equities, of course, the average returns have been around 14 to 15% is when we look at the Sensex. So when you look at equities, do not look at from short-term perspective, look at from long-term, hold it for long-term, because this is one of the biggest mistakes that people does, is to take out money in short-term. Jaldi returns ban gaya, nikal gaya. And particularly in last 1 year, this has happened. A lot of investors have seen investments growing by 40% and 50%. Just one suggestion, whatever has happened in last 1 year is an exceptional situation. Usually stock market doesn't recover so quickly and give you such high returns in a short span of time. And ideally, the more you hold right now, it may work for you. And when to redeem, that's an important question. It's very easy to say that, keep on investing, but when should we take out the money is equally important. So you should only take out the money from any investment, and particularly equities also, is whenever you're nearing your financial goal. If the fund is consistently underperforming its peers for maybe 2 to 3 quarters, then it makes sense to relook into that whether this fund is doing something wrong. So underperformance is another part, but of course you'll have to give some time to it. Each and every fund goes through a cycle of underperformance. That's where I think that the skill to remain invested is important. But if consistently, if the fund underperforms its peers, then it is time to relook into that fund. And if there is a change in the mandate, so there is a fund which probably I was investing into thinking that this will only invest into big companies, suddenly start investing into some part of the money into mid cap companies, or it switches into the mode of becoming a multi cap where it will have 25% in small caps, then there's a mismatch. And then probably I will have to come out of that fund and look at a better fund where it only invest into large cap. And of course, last is of course very important, that at time of emergency, if in case you need that money and there is no other source of money, you have to take it out. So don't be under that impression that I have invested for 7 years, but if in case we have seen situations in COVID where people had to take out money, without thinking twice. In such a case, simply take out that money, use it for your emergency, and you can certainly build the portfolio after some time.